Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Very good. Evan, today I wanted to talk about really the macro side of things, and I know we always do that, but I've been reading a lot in the last few weeks really about is the market moving ahead too quickly? You know, is it overvalued? Then we're looking at things like rising bond yields, what sort of impact that's going to have on investors down the track, and there's a little bit of scaremongering involved, I feel anyway, and I'd like to sort of put some real definitions around what's going on at the moment in terms of global economics and really what investors should be looking at, which is the main thing. And as we know, economies move around all the time, so what's happening now may or may not be indicative of what happens sort of way out further down the track, and investors need some real boundaries there. So what's your take?
That's broad stuff, isn't it? I mean,
I've gone on.
Gone broad stuff, that's great. The best thing about macro stuff and the stuff that I love talking about is that the way it meshes and sort of comes into everything else. So looking through all your questions there, everything that's sort of feeding into it. So last week we talked about the fact that at the moment there's this big liquidity pump still going on that's been pretty much been in there since the GFC. So all this stuff around central banks, the unbelievable accommodation, very, very unconventional monetary policy, places like Europe where they've actually got negative rates in some of their interest rates. Same with the Bank of Switzerland, you've got the Bank of Japan doing something similar. The fact that in Japan you've got them actually purchasing their own bonds. Right, so the majority of Japanese government bonds are owned by their own people because the bank owns them. All this kind of stuff. So really unconventional material. There's always that question about, and the skepticism, as you talked about, comes about how do you get out of that? How do you start to unwind these unconventional policies without creating fractures and creating volatility and blah, blah, blah. Now, getting back to your question about the bond market, that's a really interesting one because you're starting to see signs about that. Now, the US bond market's really interesting. It's the most mature bond market around, has huge, huge amounts of liquidity, something that here in Australia we could only dream of in terms of that kind of idea. There is concerns in it, and the reason for it is that raising yields is always that question around what's causing a sell-off in the bond market. Is it because there's risk in the US economy? Well, no, you can see already with their fourth quarter numbers that have come out and their GDP growth forecasts that they're getting better. Is it around monetary policy changing? Yes, definitely, and I'll come to that in a minute. Is it also just general risk mitigation and moving around that as well? Yes, that's probably interesting thing. Some people would argue that what's going on in the bond market in the US right now is actually bond traders almost, and I hate using this term, holding a gun to the Fed's head about do not raise rates any further. The liquidity that's there is good for the US wealth creation. It's good for US market. It's why they keep printing record highs. It's all you see when you basically wake up in the morning is the S&P or the Dow or the NASDAQ have made record highs. Now that's off the back of earnings as well, but it is because liquidity is still very, very easy. Even though they've had 5 rate rises, it is there. So there is this risk that with increasing bond yields, it's an increasing talk about rates, it's an increasing risk around funding, because again, you've got to remember it's US sovereign debt that you're trading, that's what it is, and does that put pressure on US ability to borrow because obviously the interest they're paying is increasing. All of that's there, but the positive side, and the reason you've got to probably look through the skepticism is that everything right now is still positive. It's still very much accommodative for growth. It's still very much accommodative for earnings. It's still very much on the idea that although central banks are talking about what they do to sort of start unwinding accommodative theory, they're still not going to do it simultaneously. Ray Dalio in Davos last night basically said very clearly that if you're in cash, you probably would be crying your cereal. That was his words. And the reason for that is that clearly risk equities, which is what equity are, risk markets, equity markets are going to continue to outperform in 2018 because the growth profile is there, monetary policy is still a little bit away from working in a simultaneous hiking cycle.
Because, at the end of the day, investors really want to know what the key themes are and how they need to respond to those themes. So at this point, we know that we're still in this growth phase cycle, and that's not going to change sort of anytime soon. We're going to see that increasingly in earnings, and we're getting into earnings season right now.
Yeah, on that's a beautiful segue because you're right. If you look at, everybody asks, okay, what does that mean for us here in Australia? Let's have a look at it. Look at the ASX. And the point out from the skeptics is that we're underperforming again. In fact, if you look at our market, we're either breaking even, depending on when you watch this, or just slightly under. The pullbacks have been very shallow. The other thing is we're still a value market, so we're dominated by the financial services side. If you look at our growth market sectors, materials, energy, health, because of places like CSL, all these kind of guys, they're really continuing on from 2017. If you look at the average price of bulk commodities, copper, iron ore, coal, our big export players, they are well and truly ahead of what was forecasted on average prices. And if you look at the quarterly numbers from the bigs in terms of iron ore, copper that they put out last week, week before, they're slightly better than expected. So you've got better average price, slightly increased in terms of demand, obviously coming from China, which saw increased supply. It's looking rosy for that bottom-up version, not something we normally talk about, but it does therefore show that the macro theme has flown through to the retrospective earnings that we're going to get coming in February. So it's a growth thematic that is playing out.
And as we know, commodities are so important to Australian investors, and really it's fundamental that demand keeps coming from China. There have been a few question marks of late I've seen in terms of will China's demand continue, but I really can't see sort of any sharp drop off in demand from China.
Yeah, you'll get it very, very seasonally and very, very short. So months in terms of what I was saying there. This time of year is always interesting because it's Chinese Lunar New Year coming up in a couple of weeks' time, and that always throws things a little bit out of whack because they not only do they have a break where they just do nothing in terms of economic output, they all have their holiday and good for them, but they then have probably March and April where they sort of almost hibernate. So you can get these short-term volatilities, but you're right, China last year for the first time in 3 years saw GDP actually expand. I mean, it's still growing at 6.9%, but what I mean is it went from 6.7 in 2016 to 6.9% GDP in 2017, and expectations are that it will hold around that. So it's been slowly coming back from double-digit GDP to what they call more sort of financially stable, but that's a real sign. Not only that, if you look, again, iron ore is a really good way of gauging Chinese growth because it has so much information around Dalian and what's going on there. You can see that they hit record levels of import of iron ore last year. You saw the demand for iron ore back towards sort of 2013 levels. Interestingly, inventory hit a record level. So there's a question about whether or not that translates, whether or not they start drawing down on inventories in this part of the year rather than actually seaborne. But all the signs from iron ore show that the growth profile was there. It's the same with the copper story as well. You can see that the Chinese basically thirst for it was really, really strong. So yes, China is an interesting one, but they themselves were slightly mildly surprised, I think is a way of putting it to you, that last year was so good and expected to be the same this year.
And just getting back to rates as we end off this segment, but we're going to be talking a lot about rates this year.
Yes, we will.
Probably every week.
Yep.
But the reality is that global rates are on the rise, but Australian rates are likely to remain.
Yeah, and that's the perfect way to put it. That's the perfect way to put it. Is that our rates are unlikely to move. So we get our inflation read next week. The wage price index, which has had so much emphasis put on it now, comes out the week after, and all of those, which are the core mandates of the RBA, look pretty flat, and therefore you're not going to be seeing the big hand force. But global rates are moving. That gets back to the original start, which is the bond market question. The one thing and the caveat you might have in the back of your head if you are a mortgage holder or looking in terms of leverage of anything, just be aware the private banks may feel pressure, like they have since the Fed has raised rates, around their own funding. So wholesale funding will see pressure. If the US, and they will raise rates, starts to put pressure on that wholesale funding side of the banks, don't be surprised to see out-of-cycle rate rises like we have in 2015 and 16. It will be probably again aimed at interest-only and also investor loans because they're the slightly riskier part of their book. That would be the only caveat. Our rates won't move from a cash point, but just be aware the private banks may have to tweak again because the US or the Europeans are starting to change their rates.
Absolutely, good point. We've already seen that with ANZ lifting up their fixed rates, and I expect we'll see more of that this year.
We will.
Yeah. Thanks, Evan. Thanks for joining us.
Thanks, Tony.
Thanks for joining us on The Economic View.